Okay, so today we are doing a deep dive into what is, you could argue it's the most scrutinized earnings report of the year.
For sure. NVIDIA's fiscal Q3, it's due on, just after November 19th.
And this isn't just another quarterly update about semiconductor sales. Not at all.
No. The sources we've stacked up here are describing this moment as a, quote, pivotal event.
A barometer for the entire AI-driven market cycle.
Yeah.
For investors, for strategists, really for the global economy. The stakes just couldn't be higher.
And that's really the heart of it for you, the learner. The core question we're trying to tackle is almost existential for the whole tech sector.
Right. Does this report confirm that the AI boom is, entering a sustainable phase of real growth?
Or has market exuberance outpaced reality? That's the big question.
So we're going to go beyond just the headline numbers today. Our mission is to first unpack the really complex macro and geopolitical landscape here.
All the tension around this stock. Then we'll review Wall Street's sky-high expectations.
Which are arguably impossible expectations. And then we'll analyze three distinct scenarios: the blowout, the inline, and the miss.
And we'll show you exactly how the ripple effects from each one will hit the entire tech sector and, really, the global investing landscape.
To really get a grip on where reality is, you can't just look at the chip market in a vacuum.
No, absolutely not. We have to start with the complex forces that are sort of squeezing NVIDIA from all sides.
Okay, so let's set the macro scene. We're in a really mixed environment.
That's a good way to put it.
On one hand, 2025 has seen inflation finally moderating a bit. That's allowed the Fed to ease up on interest rates.
Right, and that should be a powerful tailwind for a growth stock like NVIDIA. Lower rates reduce the cost of capital, making those future profits more valuable.
But it's not exactly a clear sky, is it?
No, not at all. Borrowing costs, while they're easing, they're still relatively high compared to, a few years ago.
And that persistent elevation is putting pressure on high valuation tech stocks everywhere.
Wow.
The Nasdaq has been pretty volatile because of this anxiety about AI valuations.
It's a legitimate concern about corporate overspending, especially on infrastructure.
And speaking of spending, there's a subtle positive factor on the cost side, right?
Yeah.
Energy prices.
Yeah, that's a good point. Data centers, which house all these high-powered chips, are incredibly energy intensive.
So easing oil and electricity costs, they act as a subtle tailwind for NVIDIA's customers.
Exactly. It lowers their operating budgets, theoretically allowing them to deploy new AI servers more aggressively without their energy bills just exploding.
What's fascinating, though, is the sheer scale of investment that's still happening, even with these higher rates.
Oh, absolutely. The AI boom that was sparked by ChatGPT back in late 2022, it's showing no signs of slowing down the need for this infrastructure build-out.
We're talking about the hyperscalers here.
Right. The few giant cloud providers, Microsoft, Amazon, Alphabet, Meta, they are the primary, almost indispensable buyers, and they are still announcing record spending.
And the projections from NVIDIA management themselves are, they're almost fantastical.
They are. They're projecting that global data center capex could reach an astonishing $3 to $4 trillion annually.
By 2030. That's up from, about $600 billion this year?
It's a dramatic jump. And that projection, that underpins the entire NVIDIA investment thesis, that this is a multi-year, paradigm-shifting runway of demand.
But with that kind of massive investment comes immense risk.
Which brings us to the caution flag around monetization.
This is the sustainability question. The sources we have point to concerns about circular deals.
Right, ones that might inflate revenue.
Meaning, large customers are buying chips, but they themselves aren't actually making money on the AI services they're building yet.
And the most startling example here is OpenAI. A massive NVIDIA customer, through the cloud providers, reportedly lost a staggering $12 billion in Q3 2025 alone.
$12 billion in one quarter.
It raises serious sustainability questions. What happens if the economy tightens, or if big tech has to rein in that spending spree?
It suggests the revenue growth for NVIDIA is being driven by investment, not by profit down the chain.
Not yet, anyway. And we can't ignore the geopolitics.
The reality is, U.S. export restrictions still bar NVIDIA from selling its most advanced chips to China.
And China was historically a huge market for them. Now, NVIDIA has developed modified chips to comply with the rules.
But they stopped including China in their official forecast for high-end processors last quarter.
That action alone creates a definitive drag on future growth, which is critical when you are, as a stock, priced for absolute perfection.
They've essentially written off a massive market for their most valuable products.
And the market needs to see overwhelming growth everywhere else to make up for that.
Okay, so immense tailwinds from the AI boom, but serious headwinds from valuation anxiety, monetization questions, and these export bans.
That perfectly sets the stage for the numbers. Let's look at what perfection actually looks like for this quarter.
This is Q3 FY 2026.
Right. Wall Street consensus is calling for revenue around 54.8 to $55 billion.
Now, that is still a massive 56% year-over-year jump.
It is. But it is a slight step down from the triple-digit growth rates we saw in the earlier quarters of the AI boom. The curve is naturally flattening a little.
And the profitability has to match that ambition. Adjusted EPS, that's forecast around $1.25.
Yep, up about 54% year over year. If they hit that, it's an all-time high, and it proves the data center engine is still just roaring.
And we know that the top 4 customers, Microsoft, Amazon, Alphabet, Meta, they account for over 40% of revenue.
So those big infrastructure budgets are doing all the heavy lifting. But crucially, we need to talk margins. Gross margins are expected to stay extraordinarily high. The prediction is for somewhere around 73 to 74% this quarter.
You really have to stop and think about that number. 74%.
It implies a measure of pricing power that frankly doesn't exist anywhere else in the chip sector. I mean, their closest peers are in the 50 to 60% range.
Why is that difference so stark?
It confirms they are selling a technology, their proprietary GPU architecture, that is just completely indispensable right now. It's a testament to the lack of viable alternatives.
Their competitive moat is still incredibly deep.
Exactly. And that slight dip in margins from previous quarters, by the way, that's attributed to ramping up production of newer chips like the Blackwell series.
And selling more full systems, right, the DGX servers.
Right, which carry slightly lower margins than just selling the individual chips.
Okay, so numbers aside, the thing that truly moves the stock is always the forward guidance.
Always. And we know demand is huge. CEO Jensen Huang recently revealed the company had about $500 billion in outstanding bookings through 2026.
That's an astonishing figure. It's roughly 10 times this quarter's expected revenue.
And that brings us directly to the catch-22 of these high expectations.
Okay, I have to push back a little on this priced for perfection idea, given that backlog.
Correct.
You just mentioned the CEO revealed $500 billion in outstanding bookings. If demand is locked in at 10 times this quarter's revenue, why are we even talking about a potential miss? Isn't that growth essentially guaranteed?
That's a critical and necessary challenge. That $500 billion figure, while it's powerful, it's an order backlog. It is not guaranteed revenue recognition. The sources point out these contracts often have flexibility clauses. If the macro environment suddenly tightens, or if a customer like Microsoft realizes they built too much infrastructure too fast, a situation they call digesting inventory.
Those orders can be slowed down.
Or renegotiated. So it's less about a true cancellation and more about the timing of when NVIDIA can book the revenue.
And that's what impacts the quarterly guidance.
Precisely. If the guidance suggests a slower pace of revenue recognition than analysts already assume, even if the long-term number is still $500 billion, that triggers a sell-off.
Because the stock has already soared.
I mean, it's up something like 1,000% since late 2022. It briefly crossed a $5 trillion market cap in October. It trades at about 29 times forward earnings.
So perfection is expected. And history is clear here. Even when NVIDIA delivered record results in 3 of the past 4 quarters, the stock often ended the week lower.
Because the good news was already priced in, it takes a monumental surprise to move this stock higher now.
Which brings us to the 3 possible outcomes.
And given the options market had priced in a volatile move of about 7 to 8% in either direction, let's dive in.
Okay, let's start with scenario 1, the blowout. This means NVIDIA just crushes that $55 billion estimate, issues bullish guidance, and basically confirms the AI frenzy hasn't peaked.
In this scenario, the stock goes sharply higher. It'll likely exceed that 7 to 8% range, and it could easily reclaim that $5 trillion market cap.
So it reaffirms the whole hypergrowth story.
And sends analysts rushing to raise their price targets yet again.
And the ripple effects are entirely bullish, right? It validates the whole investment thesis. The whole tech sector gets a huge positive read-through.
Oh, yeah. Semiconductor peers like AMD would rally in sympathy. It's that rising tide lifts all boats effect. AMD specifically would benefit as customers might look to their MI300 chips if NVIDIA is completely sold out.
And the AI infrastructure companies would just soar. Microsoft climbs because this validates their massive Azure spending.
And supermicrocomputer SMCI jumps immediately. For those who don't know, SMCI builds the physical server racks that house these GPUs, making them a direct proxy trade for NVIDIA's success.
And because NVIDIA is a colossus, what, 10% of the Nasdaq 100 and 8% of the S&P 500?
Something like that. Both indices would jump significantly, potentially breaking key technical levels. This outcome encourages a risk-on wave globally. Investors lean further into growth.
Okay, now, scenario 2. This is the base case. Meets expectations, stable guidance.
Right. This is where NVIDIA delivers results exactly in line with consensus, say $55 billion revenue, $1.25 EPS, but doesn't offer a huge surprise or upgrade its outlook.
Given the valuation, the stock reaction here is typically, muted, or even slightly negative.
Yeah, you'd likely see a sell the news response, maybe a dip of a few percent from profit taking. The core valuation is stable, but the stock might just trade sideways for weeks.
And for the broader sector?
It's reassuring, but it's not exhilarating. Your semiconductor peers would probably trade flat or maybe mildly down. The market just interprets this as the AI trade being fully priced for now.
And for the indices, the effect is modest. The Nasdaq might drift a bit lower with its top component pulling back, but the S&P 500 could stay stable.
Right. Strength in other sectors, like healthcare or financials, could counterbalance that mild tech softness. Global investors would basically maintain their allocations and wait for the next big catalyst.
All right, finally, scenario 3. A miss or weak guidance. This is the trigger event.
This is the one people are worried about. This could mean revenue below $54 billion or, critically, weak forward guidance for Q4. And remember, the cause matters.
A demand issue is far worse than a supply issue.
A demand issue, say, a hyperscaler pausing orders, is way worse than a temporary supply constraint.
This would trigger a sharp sell-off in the stock.
Oh, sharp one. We're talking a potential double-digit drop, maybe 15 to 20% in a severe case.
Wiping out, what, $300 or $400 billion in market value overnight?
Overnight. The stock would immediately undergo a valuation derating. The market just decides the future growth rate isn't high enough to justify that multiple, so the price falls fast.
And the ripple effects here are immediate shockwaves.
Across the entire tech ecosystem. This casts serious doubt on the whole multi-year AI upcycle thesis.
So semiconductor peers like AMD and Broadcom see significant declines.
On the fear that the total addressable market, the TAM for AI, was just overestimated.
And the AI infrastructure companies get hit hardest.
SMCI, tied directly to GPU sales, would likely tumble 20% or more. Microsoft would also decline on the worry that the infrastructure build is indeed ahead of actual user demand.
Fueling that idea that big tech's spending spree has to be reined in.
And because of NVIDIA's massive index weight, the Nasdaq 100 and S&P 500 would drop sharply. The VIX, the volatility index, would spike as investors rush for safety.
Global investors would basically de-risk, rotating out of growth and into defensive sectors like utilities and staples, or just moving into bonds.
Not a total risk-off move.
Okay, let's step back from the noise of the next, 48 hours. The long-term perspective is really key for you, the learner.
It is. Even in the disappointment of scenario 3, the fundamental thesis that AI will revolutionize industries and require vast compute resources, that remains absolutely intact over a multi-year horizon.
That's vital context.
It is. A sharp sell-off in NVIDIA, a major correction, could be viewed not as a failure, but as a healthy correction.
One that flushes out the excess speculation.
Exactly. It flushes out the exuberance and presents a real opportunity for long-term believers to accumulate core holdings at a discount.
So what does this all mean for you? In the most likely base case, scenario 2, where NVIDIA just meets the bar, it signals a shift.
A big one.
We move from a broad, blind theme trade where everything AI just goes up to a market of disciplined stock pickers. Investor discipline becomes paramount.
The easy money phase is over. Absolutely. The volatility around this report is guaranteed, no matter the outcome. The ultimate winners will be those who can navigate that short-term turbulence while keeping their eye on the multi-year promise.
Which brings us to our final provocative thought for you to consider. Given the current extremely high concentration of capital in just a few mega-cap AI stocks, and NVIDIA is the poster child holding up the market, how would you adjust your portfolio right now to maintain balance and diversification?
What specific hedges would you put in place knowing that even the strongest companies require continued perfection to sustain these valuations. The risk is concentration.
The challenge is diversification without abandoning the future of compute.
Well said.
That was the deep dive. We hope this knowledge helps you navigate the coming week. We'll see you next time.